but the record of modern forecasting contains a note of caution. Those who correctly predict a crisis rarely get it right again. The best that economists can do is to assess vulnerability. Looking at imbalances in the real economy of financial markets gives a sense of the potential consequences of a major shock. It doesn't take much to spot corrections in vulnerable economies and markets. But a garden variety correction is far different from a crisis. The severity of the shock and the degree of the vulnerability matter. Big shocks to highly vulnerable systems are ripe for crisis. In this vein, the vulnerability that I worry about the most is the overextended central bank balance sheet. I have concern for three reasons. First, central banks' balance sheets are stretched. Assets of major central banks, the United States Federal Reserve, the European Central Bank, and the Bank of Japan, collectively stood at 12.6 trillion euro in November 2019, which is down only slightly from the peak of 13.5 trillion euros in early 2018, and is more than 3.5 times the pre-crisis level of 3.6 trillion euros. A similar conclusion comes from scaling assets by the size of their respective economies. Japan leads the way at 102% of nominal GDP, followed by the ECB at 39% and the Fed at a mere 17%. Second, central banks' balance sheet expansion is a failed policy experiment. Yes, it was successful in putting a floor under collapsing markets over a decade ago, in the depths of the crisis in the late 2008 and early 2009, but it failed to achieve traction in sparking vigorous economic recovery. Central banks believe that what worked during the crisis will work during the recovery. That didn't happen. The combined nominal GDP of the United States, Eurozone, and Japan increased by 4.8 trillion euros from 2008 to 2018, or only about half their central banks. Combined balance sheet expansion of 9 trillion euros in the same period. The remaining 4.2 trillion euros is the functional equivalent of a massive liquidity injection that has been propping up asset markets over most of the post-crisis era. Third, steeped in denial, central banks are again upping the ante on balance sheet expansion to stimulate flagging economic recoveries. The Fed's late 2018 pivot led the way, first reversing the planned normalization of its benchmark policy rate and then allowing its balance sheet to grow again, following steady reductions from mid-2017 through August 2019. Asset purchases remain at elevated levels for the Bank of Japan as a critical element of the Abenomics reflation campaign. And recently installed European Central Bank President Christine Lagarde, the world's newest central banker, was quick to go on the record stressing that European monetary authorities will turn each and every stone. The reverse Yankee boom is welcome news for European bond buyers dismayed at the yield collapse triggered by the European Central Bank's asset purchase program. The Eurozone Central Bank, which resumed buying bonds in October, holds 183 billion euros of corporate debt. Toward the end of quantitative easing a year ago, it was estimated to hold a fifth of the eligible corporate debt stock. Because reverse Yankees are not usually eligible for European Central Bank purchases, they often carry higher yields than similarly rated Eurozone issues. They also made up a significant chunk of this year's longer maturity debt, including half of the 30-year corporate bonds sold, according to Refinitiv. These longer, higher yield issues were especially popular with investors. BBB rated reverse Yankee bonds of 7 to 10 years maturity can offer a spread of up to 25 basis points more than Eurozone equivalents that are eligible for European Central Bank purchase, research company CreditSight calculates. B of A's Martin reckons United States names could lure giant Asian life insurers to invest in euro debt. These investors hold over 10% of the United States credit market, International Monetary Fund data shows, but they are less familiar with Eurozone companies. If many of the United States issues come in euro format, it's easier to buy euro investment grade, Martin said. It will create additional demand and it will be bullish for the market. This obvious fact did not deflect the meme that the euro was fundamentally flawed and doomed. And I'm sure you will get the opportunity to read this theory again and again for a long time to come. In a way, it's a kind of economic conspiracy theory worthy of the Tin Hat Brigade, but unlike Area 51 aliens, many sensible people take it serious. There is another reason the euro will not fail, and that is that even a disunited Europe is a natural environment for a unified currency. Even in the Middle Ages, the silver penny was the same across most of Europe. That is maybe a stretch, but in the 19th century there was an exact monetary union system called the Latin Monetary Union, in which Greece, France, Austria, Italy, Belgium, Spain, Switzerland, Romania, Luxembourg, Finland, etc. joined. Even Cambodia, Russia, Venezuela, and the Pope signed up to the currency standard. This monetary union lasted from, depending when you want to start counting, 1806, but most definitely 1865, and wasn't completely wrecked until the horrors of the First World War. In fact, the monetary union wasn't completely dead until 1927, and even some coins were still being minted for general use by the Swiss up to the 1960s. Promoted. What is more, as I write, a major member of the EU, Britain, is meant to be seceding from the EU. Is the euro weak? No, it is strong. It is so strong the European Central Bank is setting negative interest rates and, as I write, has dropped them even further into negative territory. The currency is so strong, the EU is having to punish euro holders for hoarding it. Make no mistake, the euro was, is, and will continue to be strong currency. So the argument might be the EU will collapse even while the euro is strong, because a lot of Europeans will become fed up with the EU in general. What ails the United Kingdom electorate will come to ail much of Europe's voters, and they will tear Europe apart. The death of the EU will kill the euro, not vice versa. This is plausible until you come to regard the current situation of Brexit. The United Kingdom, it turns out, cannot check out of its membership. Even if the United Kingdom's cornered leadership perform a Houdini-like escape, it will be clear to see that the United Kingdom, by far the most Eurosceptic country in the EU, will have had to trash its institutions and economy to do so. If the United Kingdom stays, it will underline there is no leaving the EU, and if it lives, its wreckage will become a salutary example of how leaving the EU is not a palatable option. What is more, forgetting the effect of watching the United Kingdom swing on the gibbet of Brexit, the EU, once rid of perfidious Albion, will move ahead with the federal project and tighten further the ties that already bind European countries inescapably together. As such, the EU project has no end in sight. What should investors do? Short the euro against sterling if you think Brexit is dead, or go the other way if you think hard Brexit is coming. However, don't figure in a euro collapse in any thesis in your lifetime unless you think a near global extinction event is near. It will take a proper textbook historic catastrophe to break the euro. Despite what the dollar hegemons expound, the euro is going to be a strong currency until further notice. That's why the problems in repo are just beginning. Looking ahead, we see nothing but trouble in Europe. Prime Minister Boris Johnson put the threat of hard Brexit back on the table by ruling out a further extension of trade negotiations beyond the end of 2020. The euro and the British pound gave back their gains from last week. Gold acts like it's trapped under something heavy, refusing to budge more than $10 week to a week. And the equity markets rally because as bond yields collapse, they are a good source of real yield. And this brings me to where I think the accurate systems lie. Deutsche Bank holds more than $50 trillion in interest rate derivative swaps. All across Europe, banks are struggling with negative rates, killing their core business, especially Deutsche. I would argue, given the size and the persistence of the need for offshore dollars, that Deutsche Bank has already, for all intents and purposes, failed major United States banks like Goldman Sachs are in trouble since they are the most exposed to Europe. Those swaps cannot blow up with huge moves in interest rates, or it's lights out for a lot of United States banks exposed to the underlying debt. In this case, it's the more than $12 trillion in negative yielding European sovereign debt. This is the biggest bubble in history, and the only thing keeping it afloat is momentum traders front-running the central bank's buying, with the European Central Bank almost certainly to liquefy the markets even further. It makes sense that we are going to continue to break down. At this point, I believe that rallies are going to be selling opportunities, and therefore I think it's only a matter of time before we see a bearish pressure re-enter the situation. The German economy is struggling, and that being the case, it's likely that the euro is going to pay the price. At this point, the markets looks like a favor the United States dollar, not only because of the economic concerns, but also because of the treasury market has been attracting a lot of flow due to the massive amount of fear out there around the world. This is a typical correlation, so it's very likely that we continue to see this same dynamic. Ultimately, rallies are to be faded as the European situation deteriorates. Not only do we have problems with the German economy, but European banks are starting to get scrutinized as well. And at this point, I think the currency markets are starting to play out. Most of the idea, comment, information, and criticism containing in these videos have been created by Daily News Report. Before making any important investment decision, use the information contained in these videos as a starting point for conducting your own research. If you make any investment or legal decision, it is advised to consult an expert before making this decision.